Collapse file number 9. Subject: Volkswagen and the hedge funds who bet against it. Date: Sunday, October 26, 2008. Murder weapon: a single press release, barely 200 words long. Cause of death: the shorts sold shares that did not exist to a company that already owned nearly all of them. This is the Collapse Files. By Tuesday afternoon, in the middle of the worst financial crisis in 80 years, a maker of family hatchbacks was for a few hours the most valuable company on planet Earth. This is the file on the trap that put it there. 3 years in the building, 200 words in the springing. Autumn 2008. Lehman Brothers is a month dead. Banks are dying by the week. Every stock on Earth is going down, and the professionals are making fortunes betting that they will keep going down. Short selling is the only trade that works. And in Germany, one target looks irresistible. Volkswagen, a car maker heading into a recession that will crater car sales, yet its share price strangely refuses to fall. To half the hedge funds in London and New York, that can mean only one thing: it is overpriced. It is a gift. So they borrow Volkswagen shares and sell them, planning to buy them back cheaper when gravity does its work. By late October, short positions equal to roughly 12% of Volkswagen's ordinary shares are open. Some of the most famous names in the industry are in the trade. It is, they believe, the closest thing to free money the crisis has offered. They believe they are the hunters. They have not understood, and this is the heart of this file, that they are standing in the middle of a trap that has taken 3 years to build. Because someone else has been quietly buying Volkswagen. Porsche, the sports car maker from Stuttgart, a company 1/15 Volkswagen's size, a minnow circling a whale. Since 2005, it has been accumulating VW stock, publicly insisting, again and again, that it has no intention of taking the company over. The man in charge is Wendelin Wiedeking, the executive credited with saving Porsche from near bankruptcy in the 90s, now the highest-paid boss in Germany. Confident, combative, and with his finance chief Holger Herter playing a game very few people can see. The instrument is the key to everything. Porsche is not just buying shares. Through banks, it is quietly amassing options on Volkswagen stock, and specifically cash-settled options, a species of derivative with one magical property. Under German disclosure rules as they stood, cash-settled options did not have to be publicly declared. Ever. A company could build a claim on nearly a third of Germany's biggest carmaker, and the market would see nothing. No filing, no flag, no warning. 5 times between March and October of 2008, Porsche denied it was seeking to take over Volkswagen. The denials were read out, printed, and filed away. The options kept piling up. And here is the first twist in the file, because by now, calling Porsche a carmaker is a category error. In its financial year 2007-8, Porsche reported around 8.5 billion euros of pre-tax profit on roughly 7.5 billion euros of sales. Read that again. The profit was bigger than the revenue. The cars had become a rounding error. The overwhelming bulk of those profits came not from selling sports cars, but from its Volkswagen position. By one analysis, the options alone earned nearly 9 times what the entire car business did. Analysts had started calling Porsche a hedge fund with a carmaker attached. The hedge funds shorting VW were not betting against a stodgy manufacturer. They were betting against a better-armed version of themselves. Now do the arithmetic that London somehow never did. The German state of Lower Saxony owned a fifth of Volkswagen, 20%, held for decades, never for sale. Whatever Porsche owned came out of what was left. And 12% of the company had been sold short, borrowed shares that would, someday, have to be bought back. Every short sale is a promise to buy later. The shorts were, collectively, obliged to purchase 12% of Volkswagen at some point in the future. The question nobody asked was, from whom? Sunday, October 26, 2008. Markets closed, traders at home with their families. At Porsche headquarters in Stuttgart, a press release is finalized. It is a kill shot. Exhibit A in this file, the release itself. Read it the way London read it that evening line by line, with the weekend dying outside. Paragraph 1, Porsche holds 42.6% of Volkswagen's ordinary shares, then the line that ends Korea's cash-settled options over a further 31.5%. Total claim, 74.1%. And the reason Porsche gives for announcing any of this at all. Quote, the dramatic distortions on the financial markets. It is speaking up, it says, so that short sellers may have the opportunity to settle their positions without rush. Without rush. Now finish the sum the traders did that Sunday evening, hands shaking. Porsche's claim, 74%. Lower Saxony, 20%. That leaves a free float, shares actually available to buy, of roughly 5 to 6% of the company, and 12% needed buying. 12% of Volkswagen had to be repurchased, out of a cupboard containing 6. This is what traders call an infinity squeeze. The price of a share, in that situation, is not what the company is worth. It is whatever the man who owns the cupboard says it is. Monday morning, October 27th. The Frankfurt Open is carnage. Volkswagen, which closed Friday around €210, doubles past 500 by the close. There is no analysis to do. Every short in the world is trying to fit through the same 6% doorway at once. Risk officers ring traders at home. Prime brokers demand collateral in cash now. Funds that were up for the year on Friday are fighting for survival by Monday lunchtime. And the worst part, everyone can see the maths. There is no price at which enough shares exist. Tuesday, October 28th. The chart goes vertical. Volkswagen touches €1,005 a share, up nearly 500% in 2 trading days. At that price, the company's stock is worth around €296 billion, which means that on that Tuesday, Volkswagen, a manufacturer of Golfs and Polos, in a collapsing world economy, passes ExxonMobil to become, briefly, the most valuable company on the face of the earth. Not because anyone believed it was worth that, but because a squeeze does not care what things are worth. The losses on the other side were biblical. By most estimates, the shorts lost something in the region of $30 billion in a matter of days, one of the greatest single wealth transfers from professional investors in market history. In London, funds screamed foul. One manager called it a nuclear bomb going off in the market. The hunters had been the prey the entire time. Porsche, the little sports car maker, had outthought, outweighted, and outlawyered the sharpest money in the world. On the Wednesday, Porsche released a statement saying it would settle up to 5% of its options position, deliberately putting shares back into the market to let the pressure out. The price collapsed almost 60% over the following 4 days. The squeeze was over. The counting began. Porsche's winnings from its Volkswagen derivatives across those years were never given as one official figure, but estimates ran from €6 billion to well past 10. For a company that sold fewer than 100,000 cars a year, it was the most profitable trade in the history of the auto industry. Executed legally, a court would later confirm through a gap in the rules that has since been closed. But this file records casualties, and one must be recorded plainly. Adolf Merkel was one of Germany's richest men, a reclusive industrialist from a small town in Swabia, builder of a generics drug empire, a man who cycled to work. Among his positions in that terrible autumn was a large short bet on Volkswagen. The squeeze cost him, by most accounts, around €500 million, and his wider empire was already buckling under crisis debts. In January 2009, at the age of 74, Adolf Merkel took his own life near his home in Blauburen. His family said, in a short statement, that the financial distress of the crisis had broken him. He was the squeeze's most human loss, and this file offers no spectacle around it, only the record. And now the final reversal, because this is the collapse files, and in this archive, nobody stays the hunter for long. To build its 74% claim, Porsche had borrowed enormously. As the crisis deepened into 2009, it was carrying more than €10 billion of net debt, and the banks, themselves bleeding, would not extend it. Porsche had successfully stalked a whale and then choked on it. It could not afford to actually complete the takeover. Within months, the minnow was the one gasping, and the whale turned around. In the humiliating deal that followed, it was Volkswagen that took over Porsche. absorbing the sports car business step by step, until by 2012, the Hunter was simply another brand on Volkswagen's shelf, parked between Audi and Skoda. Wiedeking, the highest-paid executive in Germany, was out within a year of his greatest trade. The reckoning ran on for years. Wiedeking and Herta were charged with market manipulation over those 5 denials. In 2016, a Stuttgart court acquitted them both, the judges ruling the prosecution had not proven its case, and the acquittal became final. Investor lawsuits ground on for the better part of a decade. The disclosure loophole for cash-settled options was closed. Too late, of course. So the tally, $30 billion by most estimates, taken from the world's most sophisticated investors in 48 hours. One car company, briefly worth more than any enterprise on Earth, in the depths of a crash. Billions banked by the winner, who then lost the war within a year and was eaten by its own prey. No one went to prison. The rules were changed. And somewhere in Stuttgart, there is a filing cabinet with a 200-word press release in it. The most expensive press release ever written. File number 9, closed.